Good afternoon. We're looking at a net present value problem. First of all, let's consider some basic facts. The Connor Company is considering buying a new delivery vehicle for $30,000. And they're not expecting that the vehicle will have any salvage value. If the vehicle did have salvage value, we would have to net the salvage value against the purchase price. I will tell you it's customary when doing capital budgeting like this for companies to disregard salvage value. Basically not count on it. You don't know what will happen with your delivery vehicle. So here's a cash projection, or I'm sorry, you might call it a cash projection, but really it's an income projection after the purchase. So right now, the company usually earns $100,000 in revenue. It normally has expenses of about $50,000, and so its pre-tax income is normally about $50,000. However, if it buys the machine, the company has estimated that revenues would go up to $113,000 per year, which is an increase of $13,000, or a change, which is what that delta symbol means. The expectation is that expenses would rise $1,000 because of the vehicle, and this would bring us to a $62,000 pre-tax income, or a net increase of $12,000. So the big thing to remember here is if we buy the vehicle, we believe that every year we're going to get $12,000 more in pre-tax income. Now here's some basic facts that we would have had to gather to determine the net present value of the machine. In this case, the vehicle. First, Connor's combined income tax rate for federal and state is 40%. This, for example, might be a 33-34% federal rate and a 6 or 7% state rate. Connor uses MACR's, or Moderated Accelerated Cost Recovery System depreciation. This is a tax system, but it is very common when doing net present value calculations to consider tax depreciation, because normally tax depreciation has a direct effect on the company's cash flow. If you have MACR's depreciation, you might pay lower tax. If you pay lower tax, you have higher net cash flow. See how that works? The net income projected in Part 2 is expected to continue for 6 years. So to keep the problem simple, we didn't ask the company to analyze year by year what the changes in income from the machine might be. We just asked the company to do a quick and dirty calculation and determine approximately what the change would be. The company determined that would be about $12,000 per year. I want to caution you that at this minute, if you just sat back and said, boy, 6 years times $12,000, that equals $72,000. Hey, we should buy the machine. But wait, it's not that simple. What about inflation? The $72,000 that we get over the next 6 years is not going to be equivalent or worth as much as the $30,000 we're paying now, because we're paying the whole $30,000 right now. So the purpose of the net present value calculation that we do next is to see if it makes sense to buy the machine when considering inflation. So first we have to consider MACR's depreciation for the next 6 years. The IRS has fairly complicated tax rules for MACR's, but one of the things that winds up happening is they often come up with what's almost a list of how much depreciation is taken each year for a machine. So we've asked the company here, calculate or get us a list of MACR's depreciation and show us how much you'll be able to subtract from your taxable income each year for the machine. The first year, $6,000. The next year, $9,600. The third year, $5,760. The fourth year, $3,456. The fifth year, $3,456. The sixth year, $1,728. Is that realistic? Is it realistic that in year one, maker's depreciation is less than year two, and then from year two through year six, the depreciation falls for most years except for the fourth and fifth year? The answer to the question is yes, this is realistic. First, the IRS has a half year and a half month convention. And what that means is the company in certain cases can elect to just take half the depreciation in the first year or just half the depreciation in the first month. So consider the possibility that the company bought the machine in February and it decided just to go ahead and take half the depreciation in the first year. Realize that number could have been $12,000, but by using the half year convention, the company only took half a year's depreciation in year one. Year two, though, will always be a full year. So it's not unusual at all that following tax depreciation, a company's second year will be higher than its first. Now also, you studied last semester accelerated depreciation systems. Accelerated depreciation, remember, means the company decides that more depreciation will be taken in the early years of its life than in the later years of its life. It makes the argument that it's being used more heavily. I use an example in my Accounting 211 classes of a real business that I once saw that had approximately 20 drivers that went around and collected money out of pinball machines, pool tables, and jukeboxes each day. So they might have had 20 vehicles, buying one per year, and on the busiest days of the year, such as the day after New Year or the day after July 4th, all 20 vehicles might be used by all 20 drivers. However, keep in mind, the company buys one new vehicle each year, which means the newest one is this year's model, but the oldest one is 20 years old. Now consider some of the lightest travel days. Imagine a Monday morning, or imagine Christmas Day. It might only be that 2 or 3 collectors are needed. Which vehicles do they run to? The brand new one with the heat cranking in the winter, the air conditioning cranking in the summer, and a good stereo? Or do they go for that 20-year-old vehicle that has all the seats ripped out, air conditioner doesn't work, car stalls, and they need assistance every other minute? Answer is they probably go for the new ones. So the new ones do very often tend to get used up more quickly. I would make the argument that the accelerated methods of calculating depreciation are accurate. They accurately portray what happens in the life of a piece of equipment. Well, anyway, having justified makers here, now what we're going to do is compute the net present value using it. And then finally we're going to ask the question, should Connor buy the vehicle? So this slide provides computations of net cash flow. Remember when I corrected myself and said income is not necessarily cash flow? So notice each of the 6 years we have $12,000 of income. You just see that number going all down the left. However, in the second column, makers, this is a subtraction. This is a depreciation expense number. And notice those numbers from the previous page. $6,000 for the half year depreciation in the first year, $9,600 for the second year, and so on. Notice then in year one that $12,000 minus $6,000 equals taxable income of $6,000. Notice in year two that $12,000 minus $9,600 is taxable income of $2,400. Notice in year three that $12,000 minus $5,760 is $6,240 of taxable income. And then taxable income rises in year 4 and 5 to $8,544 And finally, in year 6, it's $10,272. But wait a minute, this is taxable income. There must be a tax paid. And we said earlier, we assume for this company it's a 40% tax. So, if there's a $6,000 taxable income and a 40% tax, then the net cash flow is $6,000 plus $2,400 or $9,600. Sorry about that. That was a mistake. Let me explain that issue. So the tax at 40% for year 1 is $12,000 income minus the 40% tax of $2,400. That creates a net cash flow of $9,600. $6,000 plus $2,400 would have been $8,400, and that's not what we're doing here, nor would that be the net cash flow. Year 2, $12,000 new income minus $960 is $11,040 of net cash flow. Year 3, $12,000 of net income minus $2,496 in tax gives us a net cash flow of $9,504. Year 4, income of $12,000 minus tax of $3,418 gives us cash flow of $8,582. The same calculation repeats in year 5, and net cash flow is again $8,582. In year 6, the income is $12,000, tax is $4,109, net cash flow $7,891. Well, now we have to do the net present value calculation. We take these cash flows that we computed on the previous slide, and we schedule them down the left column for the 6 years. Then, however, we have to consider the inflationary factor. So we use the present value of a dollar tables. Remember, present value tables usually come in 4 varieties. The present value of a dollar, which is the one we're using now, that is, if we get money in the future, how much money is that worth today? We also have present value of an annuity, which we're not going to use in this example. We have future value of a dollar, which we're not going to use in this example. And we have future value of an annuity. Now, we would have to ask management, or possibly we would ask experts, what kind of inflation do we expect? How much should we discount this? And in this problem, we're expecting 10% inflation. That's a little high for what we've seen in the recent past in real life, but we go ahead and use it to make the problem simple. If we were using a real number here, the present value might be present value of a dollar at about 2% per year. However, the calculation would work the same way. You take the $9,600 for year 1, multiply it by 0.9091, and the present value would be $8,727. Now, you can see as you go on down the page how these calculations work. It's always the net cash flow times the present value factor equals the present value of net cash flow. But look at year 6. 7891 times only 0.5645 gives us a present value there of 4454. So net cash flow of $7,891 in year 6 is only the same as $4,454 today, if indeed the inflation rate's 10%. This is pointing out the fact that dollars 6 years from now are worth significantly less than dollars paid today. So when you add these numbers up for all 6 years, you come to $40,635. It's quite simple then. You just subtract those from the initial $30,000 investment. You don't put any type of present value adjustment on that, and you come up to $10,635. That's the net present value of this asset. This is just showing you a table. You would get one like this out of your textbook and find the right rate and the right number of periods. In this example, the final thing we had to do is determine if Connor should buy the vehicle. And the answer here is yes, Connor should buy the vehicle because the net present value is equal to or greater than 1 cent. So one final thing to caution you about is that you don't think about other things in here like, other people would be expensive, we have to hire somebody else to run the machine, in this case the delivery vehicle, there might be extra insurance on the vehicle, those might outweigh the penny, or in our case the $10,000. You don't think that way. Instead, the net present value calculation should have every single thing, all the insurance, the additional salary, anything like that, in the adjustment to the net income for the year. So if you remember way back to the beginning when I showed you the $13,000 of additional income and the $1,000 of additional expense, one way you could look at that would be the extra $1,000 of expense was for the extra driver. Well, hopefully this shows you how to do net present value. If you have any questions, please give me a call, give me a text, or of course you can email me. Take care.